Take, make, dispose. That's how a linear economy works. It's not how we work. We believe that what we make should be collected, recycled, and made again. It's good business that's good for the environment, good for the economy, good for our communities, and good for the world, leading the way towards a circular economy. Impact.
Good afternoon, ladies and gentlemen. Welcome to Impact Limited's final results presentation for the year ended 31 December 2021. Bruce Strong, CEO, and Brett Clark, CFO of Impact, will be taking you through the presentation. Should you have any questions, please submit your questions by using the question tab at the bottom of your control panel, which I will post to Bruce and Brett on your behalf at the conclusion of the presentation. I now hand you over to Bruce Strong.
Thank you, Marlies, and good afternoon, everybody, and welcome to our 2021 results presentation, which Brett, our CFO, and I will take you through over the next hour. Impact delivered a pleasing performance in 2021, successfully navigating the challenging business environment. We have remained firmly anchored in our purpose of providing our customers with innovative, sustainable packaging, giving effect to the circular economy through our integrated business model, and making a difference in the communities where we operate. All of this underpinned by our values of being resolute, trustworthy, and responsible. Customer demand was robust across most of the product categories during 2021, and margins improved due to increased sales volumes, better operational efficiencies, and a favorable sales mix, which offset the significant increase in the cost of raw materials and other inputs. Unprecedented supply chain constraints globally and across all sectors affected the availability and cost of raw materials, with recovered paper, plastic, polymers, electricity, and several processed chemicals escalating well above inflation during the year. The supply chain challenges led to increased demand from local customers for locally produced products, from which we benefited. Thanks to the foresight and ingenuity of my colleagues, we were able to operate without significant interruptions, although the customer demand exceeded our capacity in certain businesses, especially during the second half of the year. Decisive action was taken by management and staff of all operations affected by the unrest in July 2021. There were no injuries to employees nor any damage to Impact's property. All of the KZN operations were closed for up to 8 days, which resulted in lost gross profit of approximately 20 million rand due to the reduced production and sales. We are particularly grateful for the ongoing commitment of our staff across the business. COVID-19 protocols are well entrenched and still enthusiastically adopted by all employees, which was a crucial aspect of limiting the impact of the third and fourth COVID waves on our business. We're encouraging employees to get vaccinated through awareness campaigns, giving them time off to go to get vaccinated, providing transport to vaccination sites in some cases, and in others we're inviting the Department of Health to vaccinate on site, where we've got enough people on those sites. And I must say the uptake has been quite encouraging. Impact Operations Pty Limited, the group's main South African operating entity, retained its level 1 BEE rating, a good achievement considering the rules keep changing. We've also continued to invest for the future. Good progress is being made in implementing the group strategy, with several growth projects successfully completed during the year and others approved and currently under construction. During the year, the board approved over 700 million rand in investments to support growth, innovation, improve margins, and to ensure that the resilience and sustainability of our operations. These projects include facilities, new technology, plant equipment, and solar power to improve efficiencies and expand our capacity to meet growing customer demand. Commercialization of Delisu's 280 million rand sodium sulfate facility commenced successfully on 1 March 2021 in Piet Retief. The plant has met its design throughput and quality objectives, and the demand for its product has been robust. Expansion of Impact's solar PV portfolio is progressing well, with 3 new installations commissioned during 2021, bringing the group's total installed installed solar capacity at year-end to 4.6 megawatts. During the year, the board approved a further 54 million rand investment in 6.5 megawatts of solar PV, scheduled for completion during 2022. This will bring the group's total installed renewable energy generating capacity to over 12 megawatts by the end of 2022. Further solar PV project proposals are being developed for consideration by our board during the course of this year. Impact Plastic Containers has established 2 new operating sites, as I shared with you in August last year. And the following slides just give some update on these various projects that I did share in August at the investor presentation. The first of MPC's sites will be a food-approved factory at Castleview, Gauteng, to expand our injection molded bins and crates product range. The first machine was commissioned in November 2021, with a balance of the 178 million rand project due to be completed by the end of 2022. At the end of the project, at the end of this year, we'll have 8 new machines in the facility, and with a target of getting up to 15 or 16 in the next 2 or 3 years, and bringing our total capacity there to 16,000 tons. The second project in plastic containers is the new 30 million rand recycling facility in Brits, Northwest, which is due to be completed during the first half of this year. The top right picture there is the completed building. We are still busy with some stuff inside. You'll see some of our products outside on the top left of the picture. And that recycling machine that you'll see at the bottom right is the one that's inside that building now and being commissioned. What this project does is it gives us more space to recycle. We have been recycling for a number of years, but it enhances our ability to close the loop by increasing our end-of-life buyback arrangements with customers for their bins and crates, and offering increased recycled content in new products, which they all are very eager to get. Impact Recycling's new purpose-built facility near Durban in KwaZulu-Natal is also progressing well. You'll see the picture on the right shows the building as a week or 2 ago. It's really coming on. It's due to be completed mid this year, although some of the aspects will only be available at the end of the year. This is a 150 million rand investment, and its main objective is to supply Felixton Paper Mill with waste paper from a radius of within 250 kilometers or 300 kilometers, which it will do. We'll also use a facility as a storage space for stuff that we currently rent out, which will reduce costs in the business overall. This investment in recycling will also support a recently approved investment of 126 million rand to increase the Felixton Mill's production of lightweight recycled containerboard by about 8% to meet our increased customer demand in that business, especially for the lightweight products. This project entails a new shoe press, which is on the paper machine, and an increase in fiber processing capacity, in other words, waste paper processing capacity. It's due to be completed by the end of 2023 due to the delays in ordering or shipping equipment at this stage, given the supply chain constraints. But some of the project will be completed at the end of this year, specifically the fiber processing facility. We're also investing in Impact Corrugated and Detpak's paper converting capabilities, including a new customer service center in Limpopo, which I did show last year, to meet growth in demand for paper bags, punnets, and corrugated boxes, particularly in the fresh produce sector. We've also recently reached agreement to acquire 2 properties, one in Port Elizabeth and the other in Nelspruit, which are home to Impact Corrugated operations and are currently being upgraded to accommodate approved investments in new corrugated and converting equipment. We've also been developing and giving opportunities to our people in our business. The Impact Foundation Trust Bursary Scheme continues to make a tremendous difference in our communities. This scheme is aimed at children of our employees, and to date we've supported 48 historically disadvantaged students in their tertiary education and allowed them to really reach out and meet their aspirations by going to university. So far, 23 of those 48 have graduated, and we provided 17 internships in the company to give them work experience. The nature of the program is such, the way we've designed it, is that these students can study any subject. They're not limited to studying subjects that are particular to our business. And it's been fascinating to see. You'll see in the picture there, we've had our first two medical doctors graduate last year. Also in the top picture, you'll see in the middle there is Neo Dongwana, one of our non-executive directors, but who also happens to be the chairman of the Foundation Trust. And Neo is so enthusiastically taken on this project of really inspiring these young adults to go and study and better themselves through their studies. And it's been tremendous to see the impact this has made on these people. And even more so that they are children of our employees, which is heartening. Increased demands on the group management since the start of COVID-19 has heightened the risk of burnout. We've seen across many of the businesses, across many of our customers, suppliers, and others, that this appears to be a concern across all areas of the economy. To this end, we've implemented mitigation measures and support measures across the business, such as mandatory leave and specific guidelines on remote work. Another area we've really had to pay attention to develop and support our people and our colleagues during this time. The safety of our workforce is also a critical indicator of operational performance. Management's commitment to safety was once again demonstrated in the pleasing progress made in the leading safety indicators. The safety culture renewal program we started a couple of years ago has progressed as planned, addressing matters such as competence of safety managers, leadership training, and the simplification and standardizations of safety systems across the group. All through our newly established e-learning platform, which has been a tremendous resource. Since we launched it last year, middle of last year, we've had 530 people already register, and we've already completed 300 odd courses on this e-learning platform, including the training of 24 safety practitioners in 2021, who are now on track to complete the full CETA accredited OSHPRAC course in 2022, which is essentially making sure that our safety leadership is in place. Notwithstanding these efforts, I'm nevertheless disappointed to report that the group's lagging safety indicators, such as the LTIFR and the SIFR, deteriorated from the excellent levels achieved in 2020, possibly attributable in part to the so-called COVID-19 fatigue that we've seen across society. We have recently set new water, energy, and carbon emission targets for 2027, having successfully really gone for those targets that we had to 2020. These new targets have been set off a 2019 baseline, which more reflected normal production, because 2020 we had a number of stoppages across many businesses. These targets will form an integral part of management's key performance areas in future. And as I did report last year, we made notable achievements in our 5 years to 2020 regarding these targets. Further details regarding the targets will be included in the integrated report, which will be published at the end of March or around that time. Impact's integrated business model underpins our belief in closing the loop in paper and plastic packaging through creating systems for recycling and the beneficiation of recyclables. Impact is one of the few businesses that collects nearly every product category we produce for recycling. We welcome the government's extended producer responsibility regulations implemented in May 2021 and now in force, as they will strengthen our model and bring the rest of the packaging value chain into the circular economy. During the year, Impact held a number of webinars to inform customers and the general public on the implications of the regulations and how they can improve their positions, creating opportunities for Impact and for our customers to develop strategic partnerships across the packaging value chain. For those interested, you can view the webinar online. I think it's actually available on our website. Increased recycling has necessitated a clear understanding and focus on food safety for packaging made from recycled materials. Our efforts in this regard go back many years, given our long history of recycling. Just for those who don't know, we've been recycling since the 1950s in one form or another. All Impact sites that supply food contact packaging are certified to international food safety standards. Additionally, we support fundamental research to uphold our responsible manufacturing principles in a packaging value chain that is shifting more towards recycled materials. Through this, we've been recognized as a thought leader in food safety packaging, in food safety in packaging. This has allowed us once again to engage our customers on a strategic level and leverage opportunities for business growth based on scientific evidence, not just hearsay. Innovation is a cornerstone of our business, and our investments in research and development allow us to identify new ways to meet customers' packaging needs, improve their offerings, and contribute to the circular economy. Our efforts in this regard were once again recognized through a number of industry awards. Impact received 7 product design awards at the 2021 IPSA Gold Pack Awards, including the prestigious Gold Pack Trophy, recognizing PetZorb as the overall winner. A further 2 awards were also received from the South African Plastic Recycling Organization. In the picture that you see on the screen, you'll see the tray in the middle is a PET tray that we've called PetZorb. And for those of you who buy meat or fresh produce, specifically meat, you'll see that often the tray, if it's a styrene tray or a PET tray, it'll have a pad, an absorbent pad in the tray to absorb the liquid that comes out of the meat while it's on the shelf. So this design has got a whole lot of little microcells, as you can see in the little zoomed in portion there. And those microcells, through the surface tension of the liquid, retain the liquid in the microcell. And you can actually turn that thing at an angle of more than 45 degrees, and the liquid stays in the microcells, which means that when a consumer buys the product in that tray, they don't have the need for the pad, the absorbent pad, which is a huge saving from a recycling point of view. And on the shelf, it presents very well because you don't see any of that pad or the liquid in the tray when it's on the shelf. So this is being really enthusiastically adopted by our customers. The other product, the top right, you'll see the paper flower pots, which is an extension of our paper punnet range that I've shown before. That won an award as well. And the paper raisin tubs at the bottom, which are replacing PET tubs. On the left, you'll see Envelope, which is a courier bag produced by Detpack, sealable and tamper evident. And in the top left, we've got one of the home care bottles, which has incorporated a lot more recycled material than it had in the past through our designs. These innovations, as I'm sure you'll agree, illustrate our commitment to manufacturing products that fit into the circular economy, from the design stage to the more sustainable end-of-life options. Another aspect of our strategy is, of course, portfolio optimization. And it's in this light that the board has decided to sell the plastic trays and films business, Impact Versapack, as a going concern. Versapack is a leading producer of plastic trays and films with a well-established brand, blue-chip customers, and a solid asset base. The reason for the decision to sell is that Versapack's products are not fully aligned with Impact's strategy. The company is currently in the early stages of engagement with potential buyers for the business, and it is anticipated that the sale could take several months to complete. For this reason, Impact Versapack is disclosed separately in the 2021 annual financial statements, with the assets and liabilities being reported as held for sale and the income statement reported as a discontinued operation. And there is a slide at the end of the presentation in the deck summarizing the key financials of Versapack for you to look at. In summary, just on the context and the introduction, I hope that the information we've shared so far today demonstrates that while conditions may be very challenging and the future uncertain, we at Impact have a clear sense of purpose and the willingness, drive, and determination to do everything we can to carve out a good future for our business to the benefit of all of our shareholders. Moving on now to the financial results. And just a reminder that the results presented here are for continuing operations, which exclude Versapack. As I said, there is a slide at the end for those who want to find the key financials of Versapack. Just to repeat that customer demand was robust for most of the period across most product categories, and margins improved due to increased sales volumes, better operational efficiencies, and a favorable mix of products, which offset the significant increase in costs of inputs. Group revenue from continuing operations increased by 13% to 11.5 billion rand, with sales volumes up 8.8% and average prices up 3.8%. Gross profit increased by 13.5% on the back of a favorable sales mix and good demand. Underlying operating profit increased by 56% to 948 million rand. Net debt of 1.76 billion rand, increased mainly due to a 257 million rand cash outflow in respect of the very successful share buyback undertaken in January 2021, as well as capital investments. Just incidentally, the price paid for all the shares repurchased over the past 15 months was 13.71 rand, well below the net asset value, which at year end was 26.38 rand per share. With gearing at 29.4%, the group is in a strong financial position to fund the capital projects and take advantage of any opportunities that may be presented in these turbulent times. Underlying earnings per share increased 93% to 3.60 rand, and ROCE of 17.8% is above our weighted average cost of capital. Notwithstanding the significant return of cash to shareholders during the period through the successful share buyback, the board has resolved to declare final dividend for the year of 50 cents per share. I'll move now to the segmental reports. Starting with the paper business, we've benefited from higher domestic demand, a favorable product mix, and higher average selling prices, which were partly offset by significant increases in cost, most notably of pulp and recovered paper. Revenue increased around 12% to 9.7 billion rand, with external sales volumes increasing 8.7% and average prices 3.6%. All businesses showed good sales volume growth, with containerboard and cartonboard up 9.8% and paper converting up 5.7%. External sales of recycling materials like waste paper, glass, and plastic increased 25%, but I wouldn't attach too much weight to that increase when it comes to interpreting profitability, because a lot of it is very low margin traded product. Underlying operating profit for the paper business increased by 51.5% to 875 million rand due to a favorable product mix, with low margin rolled pulp not being produced or sold in 2021, whereas we sold nearly 21,000 tons in 2020. We also had improved operational efficiencies. While the annual paper selling price increases realized during the last quarter of 2021 partially recovered the significant input cost escalations, the margin benefit will only filter through in 2022 if those costs remain stable. A second interim insurance payment of 25 million rand relating to the Springs electricity supply interruption in 2020 was approved by insurers and included in the results as sundry income. It is anticipated that a final settlement amount of approximately 45 million rand will be included in the 2022 results. I'll just cover briefly then each of the divisions in the paper business to give you some sense of what they have been contending with and where they stand at the moment, starting with recycling. Purchases of waste paper, specifically OCC, old corrugated containers, was slow in the first half of the year and dipped further in July due to the unrest in KZN. From August, collections increased significantly, driven largely by an increase in collections from our own branches. Own branch collections improved further from November with the addition of 2 new baling operations, one in Gauteng and one in Cape Town. Export prices of OCC remained high throughout 2021, which in turn kept local prices high. Supply chain disruptions kept supplies tight globally. Local supply eased somewhat towards the end of the year, thanks to a combination of increased availability of waste paper in the local market, the shortage of export containers and other shipping constraints preventing exports, and an intervention by ITAC on the issuing of export permits for waste paper. In the paper manufacturing business, containerboard and cartonboard sales increased by 9%, primarily due to an increase in domestic sales, which was partly offset by a decline in exports. As I mentioned earlier, there were no rolled pulp sales. The Felixton mill lost 8 days production due to the KZN unrest in July 2021, and Springs also lost some days to power interruptions, although nothing near the 54 days experienced in 2020. We've had numerous Eskom power interruptions in the paper manufacturing business, and the impact of severe rains causing flooding also impeded operations at times. And the flooding we experienced during the latter part of December last year and early January this year. Notwithstanding these factors, production increased 10% of containerboard and cartonboard. Internationally, the supply-demand balance for both containerboard and cartonboard remains tight, with prices increasing slowly from current levels. This is a consequence of the ongoing effects of COVID on input costs, logistics, and consumer spending. Growth in e-commerce and the anti-plastic drive has further exacerbated this position globally. It is unlikely that this will change in the first half of this year, from what we see at the moment. Price increases of around 12% were implemented at the end of 2021 in the paper manufacturing business, and this should support some margin recovery this year. Notwithstanding these increases, margins remain under pressure due to all the cost inflation that I've spoken about. The Baywhite distribution agreement, which has existed from 2005, expired on the 31st of December 2021, after having been extended beyond its initial term by 7 years. In 2021, Impact's external revenue attributable to the agreement was 867 million rand, with a profit margin of approximately 2.5%. Due to the low margin of this business, excluding Baywhite from the paper business will actually increase the operating profit margin by approximately 0.5% going forward in the overall paper segment. In paper converting, we saw corrugated volumes increase by 5.2% on the same prior year period, with good growth in most sectors. In the agricultural sector, we saw good growth in apples, stone fruit, avocados, citrus, and grapes. But these were partially offset by declines in bananas and tomatoes. Fruit exporters faced significant disruptions in supply chain, where challenges in the ports resulted in delays in getting the fruit to the market, significantly affecting quality of the fruit and prices obtained in overseas markets, particularly at the end of the year. And these challenges haven't been fully resolved, but I must say, you've got to admire the resourcefulness of our customers in this regard, who are increasingly relying on more high quality packaging to protect the fruit and to ensure that it remains fresh with these extended shipping times. The fresh packed range of products, which I have shown before in these investor presentations, continued to grow in 2021. The Woolworths Fresh Herb Pot, Fluted Pot, which I showed earlier, received a gold and a silver award at the Gold Pack Awards. We've added Pick n Pay and Spar family stores as customers, increasing the number of customers for fresh pack products to 64 from just 20 the year before. Jetpack sales volumes also showed a strong recovery thanks to a rebound in the QSR sector from the COVID lockdowns, despite the curfews resulting in reduced trading hours across most of the businesses. Jetpack has really positioned itself well, developing many new products over the last couple of years, and is also producing these bags from a product called Impact Sustainer Bag, which is made at Felixton, a product that was designed specifically for these shopper bags, for example, which are now really being taken up by most of our customers, and we're in a strong position in that particular business. Moving on now to the plastics business. In the plastics business, we showed good growth across most sectors, resulting in revenue from continuing operations increasing by 14% to 1.9 billion rand. Sales volumes improved by 9.5% on the same prior year period, with bins and crates and preforms and closures increasing by 17% and about 9% respectively. FMCG volumes declined by 6.7%. Average selling prices for the plastics business increased by 4.1%, mainly due to the sales mix, as well as the recovery of higher raw material and overhead costs in that business. Operating profit increased 34% to 200 million rand, with good increases in preforms and closures and bins and crates. FMCG's operating profit declined off a good base in 2020, but it is still doing very well, profitability-wise, and contributing nicely to the plastics business. The EBIT margin increased from 9.2% to 10.7% in the year. Sales in the preforms and closures business to the beverage sector improved following COVID lockdowns in the prior year, but are still well below 2019 levels and remain suboptimal in preforms and closures. This is being addressed by the consolidation of the 2 plants that we have in Gauteng, which is scheduled for completion in the second half of 2022. One of those plants is a rented facility, and we're moving all the operations into the facility we own in Germiston. The FMCG profit decline was on the back of a really strong 2020. So notwithstanding the decline, as I said just now, the business is still doing pretty well and delivering a good return on capital employed. The same could be said for plastic containers, where we saw good growth in jumbo bin sales and bottling and agricultural crates, and those were offset by a decline in wheelie bin sales in the last year. But overall, they had good sales across that business. I'll now hand over to Brett, who will take you through some of the financial aspects of the year, following which I'll come back and talk about the outlook.
Good afternoon, and thank you, Bruce. Variable cost of sales. Unprecedented supply chain constraints across all sectors affected the availability and cost of most raw materials, with recovered paper, polymers, electricity, and several processed chemicals escalating well above inflation. The paper business raw material costs increased by 20%, of which approximately 9% relates to increased volumes. Looking at the graph on the top right-hand side, which reflects international benchmark recovered paper prices, global OCC prices increased significantly during the period. In South Africa, recovered paper makes up approximately 30% of the total paper raw material costs. Recovered paper prices bottomed out in the first quarter of 2020, and since then prices have steadily increased and are now almost 70% from their low. When compared to the prior year, average recovered paper prices are up approximately 50%. However, virgin containerboard costs have been far more stable. As you can see from the benchmark polymer price graph on the bottom right-hand side, plastic raw material prices increased significantly during the period, with average prices of some polymers up as much as 50%. This, along with increased sales, resulted in plastic raw material costs increasing by 27%. Energy costs increased by 22%, reflecting increased production as well as costs which were well above inflation. Fixed costs. Personnel costs were up 7.7%. 4.5% relates to salary and wage increases in the current year, with the balance attributable to increased man hours linked to the recovery of production volume compared to the prior year, and COVID-19 interventions taken in 2020, not repeated in 2021. Net operating expenses increased by 8% due to higher maintenance costs and, to a lesser extent, increases in other operating costs. Depreciation, on the other hand, reduced by 7%, and this was due in part to the reassessment of useful lives of plant and equipment. Financial review. Underlying profit before tax increased by 83% to 816 million. After taking into account the higher tax charge, underlying earnings increased by 68% to 529 million. Underlying earnings per share increased 93% to 360 cents, benefiting from improved earnings and the reduced number of shares in issue. ROCE and net debt. Return on capital employed improved substantially from 11.4% to 17.8%, reflecting the increase in earnings. The group's net debt at the year end increased by 348 million to 1.8 billion due to a cash outflow of 257 million in respect of the share buyback, as well as investments in capital projects. The increase in net debt resulted in gearing increasing to 29.4%. Net finance costs. Looking at the second line on the table, average net debt decreased by 17% to 1.7 billion. The lower average net debt, coupled with the benefit of lower interest rates, meant that net finance costs for the period decreased 18% to 140 million. Interest cover improved to 6.8 times, with net debt to EBITDA at 1.2 times. Trade working capital. Trade working capital increased by 386 million, mainly due to increases in receivables of 316 million, resulting from a combination of increased sales volumes and price realizations in the last 6 weeks of the financial year. Due to global supply chain constraints, a decision has been taken to increase inventory levels, particularly in the case of imported raw materials, to ensure uninterrupted supply of product to our customers. Higher raw material inventory was partly offset by lower finished goods stock because of the strong customer demand, particularly in the paper business. Movements in net debt. Impact generated approximately 1.4 billion in cash from operations. 462 million was invested in working capital and 687 million in land and buildings and plant and machinery. In addition, Impact repurchased 15.4 million shares at a cost of 257 million. This resulted in net debt at the 31st of December of 1.76 billion. Debt facilities maturity profile. During the year, Impact operated well within its debt facilities and debt covenants, and at the year end had headroom in its facilities in excess of 1 billion rand. Impact's committed facilities to the value of 900 million will expire in August 2022, and as a result, we have commenced engagements with our banks on these facilities. Taxation. The group's effective tax rate approximates the statutory corporate tax rate of 28%, now that the tax incentive benefits previously claimed under Section 12I and 12L are no longer available. The majority of Impact's remaining recognized gross assessed tax losses were utilized during the current year. Capital expenditure cash flows. The board approved over 700 million of capital projects, some of which Bruce mentioned earlier. In addition, we have taken advantage of the depressed industrial property market by purchasing a number of our facilities in the past 2 years. During the year, Impact invested 264 million in capital expenditure in the paper business and 252 million in the plastics business. 171 million was spent in corporate, which relates mainly to the purchase of industrial properties. Dividends and share buybacks. During the year, Impact repurchased 15.4 million shares, representing approximately 10% of its ordinary shares in issue at a cost of 257 million. In addition, the board resolved to declare cash dividend for the year ended 31 December 2021 of 50 cents per share. The board will continue to focus on driving long-term value for shareholders. This will be done through prudent capital allocation in the context of growth opportunities and cash returns to shareholders through dividends, share buybacks, or a combination thereof. Thank you, and I'd like to hand you over to Bruce.
Thank you, Brett. Moving on now to the outlook. We expect to continue to benefit from the strong global containerboard and cartonboard markets, as well as increased demand for locally produced products. In addition, the annual paper selling price increase realized at the end of 2021 will assist the group in recovering increased raw material costs. However, the ongoing effects of COVID-19 and the general tightening of monetary policy could negatively affect consumer spending, while the pressure on input costs is likely to remain. The upward inflationary pressure arising from global supply chain disruptions, exacerbated by the current crisis in Ukraine, are expected to continue for the foreseeable future. The group has implemented measures to mitigate against the effects and exploit any opportunities that may arise from the disruptions. Nevertheless, the impact on the availability and cost of raw materials and demand for our products remains uncertain. Despite these immediate challenges, we are focused on the successful implementation of several approved projects and other growth opportunities totaling over 700 million that I've shared with you today to support our customer-focused growth innovation, and sustainability, and to build on the group's integrated business model, which is uniquely focused on closing the loop in paper and plastic packaging and in making a difference in the communities in which we operate. Thank you very much for listening to our presentation. Brett and I would be happy now to take any of your questions.
Thank you, Bruce. Just a kind reminder that you can post your questions by from Anton Smith. Increase in fuel and electricity costs we are seeing at the moment. Do you have any scope to further increase selling prices in South Africa?
Thanks for the question. Firstly, yeah, I think the current situation is rather fluid. So we did increase prices certainly in our paper business last year, to recover the costs that we had not recovered for the full year during the course of last year. So those price increases water. And in plastics, the pricing and that they generally are set for a year. In the plastics business, we typically price on a project, or let's call it a cyclical basis, quarterly or whatever it might be, with a cost pass through to customers. So different scenario there. I think in the current environment, our discussions to date in the last couple of weeks, especially with the European situation unfolding, is that we're going to have to be quite agile in talking to our customers and just anticipating what may come down the line. Firstly, in our own business, we've got to do what we can to make sure the costs are well managed, so we're not letting those get out of control in these times, as always, but I mean, especially now. And then secondly, we may have to consider looking forward some adjustments related to the extraordinary increases. For example, take the fuel cost. In the cases where we are selling delivered prices that are delivered prices, one may have to consider fuel cost surcharges, whatever it might be. I mean, I don't want to preempt what might come, but that is definitely something we're going to have to be thinking about in the next months. And similarly with pulp, it's hard to say where the pulp prices are going. We did manage to recover some of the lost ground towards the end of last year when it comes to input costs related to pulp. But if the pulp price was suddenly to escalate dramatically again, then we'd possibly have to go back to the market and see what could be done then in that respect. But having said that, I think everybody's under the same pressure. So I don't sit here for 1 minute suggesting or assuming that one would be able to get those cost or price increases. But I think in the current circumstances, everybody will be thinking the same way. In the recent weeks, we've been engaging many customers who are expressing similar concern about inflation generally. We're working with them to mitigate the effects, taking out all costs that are unnecessary, going back to the drawing board and evaluating our levels of engagement with those various customers and evaluating where we could take out additional costs in anticipation what's coming down the line. So I think the cost inflation across all customers into our business, well, on the front end of our business, but also our suppliers on the back end, is a very key theme at the moment, and one which we are spending a lot of our time and energy thinking about and working on to make sure that we are not, reactive in the matter, but dealing proactively as far as we can.
Thank you. Andrew Moses and Murray Moore has got similar questions. Can you please speak to the changes in your shareholder register over the last year?
Brett, I think, have you got? Would you talk?
Yes, the changes in the shareholders is on page 6 and page 7 of the integrated report, or the Impact Limited Group report,
The published report.
The published report. So I think all the details are on those 2 pages, Bruce.
In summary, if I can just read to you, or just read in summary.
So if you look at it reflects shareholders over 5%, with the biggest shareholder in 2021 being Caxton at 31.85%, and in 2020 being 26.45%, and the second biggest shareholder in 2021 being Gayatri at 9.38%. But all the information is there.
Thank you. Murray Moore from Aylett & Co. Can you provide the IFRS 16 number in underlying operating profit?
In terms of the IFRS 6, the cost in 2021 was 16 million, and in 2020 was 23 million. If you wanted to calculate how we got to the 16 million, there was depreciation of 89 million and lower rentals of 73 million to get to the total of 16 million. This has been coming down as we buy our properties.
Thank you. Murray Moore, second question. What is the group's dividend payout ratio target?
Okay, should I do this as well, Bruce? So if we have a look at our dividends, as I discussed previously, if you look at the history, what we've been paying is between 2 to 3 times. We've had 2 to 3 times cover. And also over the last few years during COVID, what we've done is we've looked at either having a share buyback or paying a dividend, or a combination of those, which will continue. So while our share price was really low, we took that opportunity, and rather than paying a dividend, we did the share buybacks, where we bought back in the last 2 years, we bought back 15% of our shares. And if one looks at the 50 cents dividend that we're paying now, I don't think that's an indication of a payout ratio. It's more an indication that we do want to pay dividends going forward. So I think we'll look at it on that front.
William Thompson from Standard Bank would like to know, are the developments with BP and Shell around SUPREF expected to impact? If so, have contingencies been put in place?
Well, I'm not really specifically what are we referring to?
BP and Shell.
SUPREF. So I can't really comment at the stage on that. I mean, I'm to be honest, I'm a bit unsighted on what you're referring to.
Rowan Goulet from Chronex. Please, can you comment on the competitive environment in paper manufacturing and converting? Is there any evidence of consolidation?
In paper manufacturing and converting. So, well, it's public knowledge, I think, in the paper manufacturing side that one of our competitors is trying to acquire a paper mill of Ethos Private Equity, or called Neopak. I think the Competition Commission is investigating that, and perhaps it'll be announced soon. So there's a possibility that they acquire that mill, that paper mill. Then beyond that, I don't know of any specific deals that are underway in that sector at this stage.
James Twyman from Prescient. Are your paper mills running at full capacity, and were they for most of 2021? Can you just remind us of your capex cost this year, and is working capital back to normal?
So the answer on the paper mills is yes. For the most part, we've been running at full capacity, and we currently, I mean, our demand exceeds our current supply in some cases. So that's still the situation. In terms of the capex, I'll ask Brett to just respond to that.
Okay, in terms of the capital expenditure, I went through on my slides. We spent 687 million on capital expenditure for the year, of which 264 million was related to the paper operation, 252 million in plastics, and 171 in corporate, which is mainly land and buildings where we bought some of our factories. As Bruce spoke about earlier, there's another 700 million of approved projects, and those are starting now. So the cash flows will still come in future years relating to those.
Asif Mohammed from Aon. Good decision by the board and management with the share buybacks done. Any plans to buy back shares at current levels?
No plans at this stage.
Then Hal Matsipa. Hi, Bruce and Brett. Great results and well done. More of a social question. Is there anything Impact can do from a CSI perspective regarding allowing the guys who collect recycling waste from our homes in the mornings with their trolleys, which can be a driving hazard? Is there a way municipalities and yourselves can solve this without the guys losing their income? Some formalization program, perhaps, that solves this driving hazard?
So just in terms of the entire collection of recyclables and specifically speaking about reclaimers in that sector, since the extended producer responsibility regulations were gazetted, well, they were gazetted actually in November 2020, and they came into effect in May 2021. All product streams and all packaging producers and paper producers are working on formalized plans, in the first instance to increase the rates of recycling and by implication collections, but also to incorporate the reclaimers and waste pickers into the formal sort of process of collecting and picking and sorting and so on and so forth. So there are a number of projects underway across multiple sectors dealing with that particular topic. We're working with a lot of NGOs as well. The various industry organizations are working together. We've done a number of studies on where the best places would be to establish, for example, sorting stations, working with local municipalities and local government in identifying land and that kind of thing. Also, in terms of many of the reclaimers are sorting stuff and having the contraries, the stuff that is not saleable, they are discarding in heaps alongside the roads, where we're asking the municipalities, for example, to provide appropriate skips and bins to enable that stuff to be collected and appropriately disposed of on landfill sites. And so I could say that there's in fact, you might even find it on Packaging South Africa's website. You'll find some details on the response to the extended producer responsibility obligations. We all have plans in this regard, and I must say there's been a lot of traction in this regard in the last 12 months. So there is a lot happening there. I'd just like to go back to William's question on the BP and Shell. Sorry, I was thinking of Safripol when you spoke about Saprif. Safripol is a polymer supplier. So the implications of the decision on the refineries by Saprif by those two major shareholders, it's hard for me to say what that exactly would mean for our business directly, other than what it means for the general economy. But insofar as it goes to polymer supply to our plastics business, our polymers are coming, and they don't come from those areas at all, if that's what you're referring to. We buy a lot of our polymers from Sasol and Safripol. And I think most of their raw materials are sourced in other places, but I do speak under correction in that regard. What we have seen on the polymer side is that, for example, both Sasol and Safripol have rationalized or otherwise reorganized their product portfolio over the last 12 months to reflect their current opportunities and also some of the challenges they've had. And that's meant that in some cases we're having to import polymers now where previously we would have bought them locally, which does have an effect on the supply chain and of course on the working capital. But so far we've been able to mitigate that, and we hope we'll be able to do so in the future. So sorry for being a bit confused when you did ask the question, William. Hopefully that answers it.
Thank you. Warren Riley from Bateleur Capital would like to know, what is the incremental profit contribution from the approved growth projects? And then he's got a second question, but I'll ask that after the answer.
Okay, so the incremental profit impact of the approved projects, well, we haven't disclosed it separately. I mean, I have indicated previously sort of that they do meet all of our thresholds in terms of return on capital employed. I'd say on balance, they're probably sort of around 20% IRR. And if you take that at the 700 million, you'll get some indication. It's hard for me to give you a specific detail on, for example, the actual cash flow in what year, but certainly over the 5-year period, within 5 years, you're sitting at those sort of levels, which would be sustainable. So hopefully, Warren, that gives you some steer in terms of what you could attribute to those projects.
The second question, what opportunities do you foresee from the Russian-Ukrainian crisis?
So it's quite uncertain as to what the outcomes are going to be and what the short-term and medium-term and long-term outcomes will be of all of this. Let's start with some of the immediate concerns. In the first instance, we do source some of our polymers from Russia. So far, it doesn't seem that they've switched them off, and so we could perhaps expect still to get some. Besides, of course, the cost escalation. I mean, the first thing we've got to worry about is making sure we've got the polymers. So that's the only real supply issue directly from those regions. In terms of Russia and Ukraine, or specifically Russia as a market, it's not a direct market for any of our products, but it is a direct market for some of our customers' products, most notably fruit exporters. A couple of fruit exporters are quite focused on the Russian market. It's uncertain at this stage whether they're going to be able to ship fruit there. I think the Russian market is still open, as far as I know, to South Africa. The biggest challenge may be shipping. So the latest report I read this morning was that I think 50% of the shipping capacity owners basically have said they're not going to be shipping to Russia. So that remains a bit uncertain as to whether our customers are going to be able to sell their products. In terms of the overall supply-demand balance in paper, obviously following the industry reports and the various experts in industry about what that could mean. Russia is, I think they don't they export a bit of kraftliner into Europe. Otherwise, they import boxboard and other papers into Russia. So, and Ukraine is not insignificant in terms of the volume. I'm not suggesting the suffering. I'm just talking now purely economics. The volumes of packaging. So it's uncertain how that's going to manifest in the market. Whether we're sitting currently with a very tight kraftliner market where there's not enough supply. That could change, but I must say I'd be speculating, and we're following the same reports that you guys would have with RISI and others, and talking to our colleagues in Europe, people that we know in Europe, just trying to get some steer, but it's still early days, so it's hard to call exactly what the outcomes will be. In terms of the opportunities, the direct opportunity is one that has continued, will be a continuation of a theme that's already in play, and that is customers of ours really trying to buy as much as they can locally. That's happened since COVID, and this situation will probably make that more important to our customers. So in the last weeks, for example, I've been engaging a number of customers where they've called us specifically just to evaluate what our capacities are, what else we could produce locally, and that was before the massive invasion in Ukraine. They were already concerned, so that makes them even more concerned in that respect. Which on the plus side is can be good for our business, provided, of course, global markets don't implode and you find a reversion of the supply-demand situation.
James Twyman from Prescient. Could you talk around the reasons for the strong demand for plastics, and will it be continuing?
So, well, the strong demand for plastic, let's just go through the various businesses. So, well, let me start with just a general theme. I think the rap that plastics is getting generally is misplaced. In terms of the anti-plastic drive, most of the plastic products we produce are the best means of packaging those products, measured on a true sustainability and scientific basis. To give you some examples, measured on a carbon footprint basis, a PET bottle that is collected for recycling has got a much lower carbon footprint than a glass alternative, as an example, and probably a better carbon footprint than even a liquid packaging, a paper packaging box or type carton. So I think the wrap there is not reflecting the true science. So that's the first thing that I could say. And then when it comes to the increased demand, I think preforms and closures, which is beverage bottles mainly in our business, in the beverage sector, it's escalated nicely off the prior year, but it's still not at the pre-COVID levels, beverage bottles in our business. So the growth has been good in the last year, but it's still not at the level we need. In our bins and crates business, we are seeing, funnily enough, a move into plastic. So to give you a simple example, 5 or let's say 10 years ago, there were no avocados exported in plastic, and today 30% of the avocados in bulk are exported in plastic, and we make a lot of those crates. We're seeing a lot of interest, for example, in the grape market. We are making crates now for plastic crates for grapes for export and also for local distribution. So there's a bit of a counter trend that perhaps one doesn't always anticipate or didn't think of. And then just those are typically returnable or otherwise not single use. So that you could expect that they would continue to grow. In the FMCG business, it might not be obvious, but I'd say 95, maybe even more % of the products that we sell for packaging in FMCG for home care, personal care, and food are recyclable, and many of them are collected for recycling. The only challenge in that respect is that most of the recycled plastic that comes out of processing those collectibles or those collected items is not currently fit for use in food grade packaging. And so that investment still needs to come in the recycling sector. That's why I had the emphasis in my presentation on the importance of food safety in packaging, especially as we increase recycling content in packaging. The products which do have a challenge in this respect in terms of recyclables are those in VersaPack, for example. We've got styrene and vinyl film. Having said that, those are still in many applications the best uses or the best packaging for the products that they package, notwithstanding the limitations they have currently on recyclability. But I'm confident for those sectors that they will be developed in time. So I hope that answers the question. So plastics, as much as the anti-plastics drive is there, the reality is the alternatives aren't better measured scientifically, in my view. And I think we are seeing more and more retailers and brand owners starting to acknowledge that they need to take a science-based approach and not just look at the litter. Of course, we have to sort out the litter, and that's about making sure that there's no leakage out of the waste management system. But once you don't have the litter, at least from a carbon footprint point of view, many products should still be in plastic for many years to come. I'm not saying that will win the battle, but that is the science in my view.
The second question, what should we assume for CapEx in 2022?
So in the financial reports, there is the capital commitments are reflected under, I can't remember the note, Vikash, what's the note?
What's the page?
The capital commitments currently at year end were about 1.5 billion. And that included the projects that are already underway and about 900 million, which is in the budget for the year, but that includes also strategic CapEx, so all of which has to still go through the formal approval process per project in the business. So the capital commitments reflect the budget for the year in effect. So it's on note 33 in the financial statements, which are available on the website and which were published today. I hope that answers the question.
Asif Mohammed, buying back your occupied property, at what net yields or cap rates are you buying the properties, and are the rentals for these properties that you bought back at market rates?
I'll ask Brett.
Yes, well, generally they come as the general industrial property market. We are say around about 11% yield that you would get them back, obviously over time, and most of our rentals are at market-related rentals. And but for instance, say take our Nelspruit property which we purchased and our Port Elizabeth property which we purchased. Both of those properties need quite big construction changes because we've ordered new corrugated machines. And with that, you're spending quite a lot of money upgrading. And when you start upgrading a factory with a landlord, he wants a 10-year lease or a 5-year lease. So strategically, it's been very important for us to purchase those properties, which we've been able to get, and we've wanted to buy them for quite a period of time, but we haven't been able to get them prior to COVID. So we purchased them now, and now we're being able to put solar on those roofs and upgrade those properties without having to sign 10-year leases to be able to do so.
Thank you.
Yes, they are market related, yes.
Thank you. There are no further questions. On behalf of Impact, we would like to thank you for your participation. Goodbye.